Listen, if you blinked, you missed it. Gold just slammed another all-time closing high, and the dollar is acting like it lost its footing overnight. And before you tell yourself, yeah, it's just another headline, stay with me, because the reason this is happening is not the reason most people are arguing about on TV, and the next 48 hours could flip the story again. Right after this, I'm going to walk you through 3 pressure points squeezing markets at the same time, why one of them is being wildly misunderstood, and the kind of move that tends to happen right after weeks like this. Then we're going to talk about the one corner of the market that can shock people if gold refuses to cool off. Quick note, we've got 1,000 plus members who get daily members-only videos and early access to every video on this channel, so they stay fully updated with the market. If you want to stay updated like them, consider joining. Just click the link in the description or tap the join button below. It won't take more than 30 seconds. Okay, now comment what time you're watching this, because I always love seeing where the community is tuning in from. Also, check the description after you watch, because I've put bonus links down there, including a premium WhatsApp channel link and a channel membership join link. Now here's what just happened and why it matters. Gold didn't just go up. It didn't just edge higher. It did the thing that makes portfolio managers sit up straight. It pushed through a major psychological zone, then refused to give it back, then closed at a level we've never seen before. That's not a normal rally, that's a message. And here's the first cliffhanger. When gold breaks out like this, the real story usually isn't gold. It's the thing gold is reacting to. Because gold is a mirror, and right now the mirror isn't flattering. In the last 24 hours, you've heard the usual suspects blamed: tariff uncertainty, a possible government shutdown, and a big central bank meeting with a press conference looming right after. That's the surface list. But the deeper list is more uncomfortable: confidence, credibility, and control. Let's start with what everybody is talking about, and then I'll tell you what I think they're missing. Pressure point number 1, trade friction. Tariffs are simple to chant and complicated to live with. They sound like a punch thrown at them. But in practice, they become higher costs that leak into everything: cars, appliances, parts, food packaging, you name it. And when businesses can't plan their costs, they hoard cash, they delay hiring, and they raise prices where they can. That's not ideology, that's mechanics. This week's threats weren't vague either. They were pointed at major trading partners. And markets hate that because it turns supply chains into a guessing game. A guessing game creates 2 reactions at once. Companies pad their margins and consumers get nervous about prices. Both reactions quietly feed demand for hard assets. From recent market updates, you can see it in the way investors rotate. They don't just buy safe havens, they also dump exposure to anything that needs smooth global supply chains to survive. So the more trade policy turns into a week-to-week surprise, the more oxygen you feed into gold. But here's the twist. Tariffs alone don't usually create a record-breaking gold close. They create headlines. They create volatility. But a record close happens when the market senses something bigger. That policy is being used as a lever, and that lever has side effects no one wants to own publicly. Which takes us to pressure point number 2, the funding cliff. Whenever you hear shut down, most people picture locked doors and closed parks. That's the surface level movie version, and the deeper issue is credibility. Because a shutdown story is really a story about priorities. It's a story about whether a government can pass a basic funding package without attaching unrelated fights to it like a grenade pin. And this week's cliff is classic. A big spending package, a midnight deadline on Friday, and a political standoff over how a security agency gets funded and how it enforces the law. That's not just budgeting, that's a power struggle being conducted with the lights on. Now, here's something most people don't realize. Markets don't panic because the government closes for a few days. Markets get uneasy because a government that argues like this also tends to govern like this. Short-term patches, last-minute deals, temporary fixes, and then we act surprised when the debt clock keeps spinning. Which leads to the number that should make everyone pause: the national debt sitting north of $38 trillion. That number matters less as a scary headline and more as a constraint, because every additional dollar of debt is a future claim on taxes, inflation, or both. And if you're trying to understand why gold is acting like a smoke alarm, you need to ask a simple question. What happens when the smoke alarm goes off, and the people in charge argue about whether the alarm is too loud? Now, pressure point number 3, central bank week. This is the one people pretend to understand until the chair starts speaking. We're in the part of the calendar where everyone asks the same question: rates, up, down, or unchanged. But that's not the question professionals are really asking. The real question is, does the central bank sound like it's in control of inflation expectations, or does it sound like it's negotiating with them? Because here's the quiet truth. Markets can tolerate a lot of pain if they believe the rulebook is stable. They can tolerate higher rates, lower rates, slower growth, faster growth. And what they can't tolerate is uncertainty about the referee. And that uncertainty is heightened right now because even when some economic data looks decent, like certain manufacturing orders or big ticket purchases, people don't feel it. That mismatch is gasoline. Based on recently published numbers, consumer confidence just dropped to the lowest level in more than a decade. That doesn't mean everyone is broke, it means people are anxious. And anxiety changes spending, voting, and investing. So you've got trade friction, you've got a funding cliff, and you've got a central bank meeting that can change the tone of everything with a few sentences. Now, here's where the conversation usually splits, and this is where retention goes up if you pay attention. One camp says, gold is rising because the world is scared. Another camp says, gold is rising because the dollar is falling. A third camp says, gold is rising because central banks are hoarding it. And a fourth camp shrugs and says, it's a bubble. But I think there's a more honest way to frame it, and it's going to sound uncomfortable at first. Gold is rising because the story of we've got this under control is losing believers. That's it. That's the engine. And if you want proof, look at the dollar's behavior. The dollar has been sliding against a basket of major currencies, and it's been especially weak against the currency everyone runs to when they want stability. When you see the dollar at multi-year lows against that safe haven benchmark, it's not just a chart pattern, it's a confidence poll. Now, I want to make this engaging, so I'm going to do something different. I'm going to recreate the debate you've been seeing, and then I'll tell you which parts I agree with, which parts I don't, and what I'm watching next. Picture a host asking, what's driving gold right now? Tariffs, the shutdown threat, rates, the general risk out there, or central banks? And the guest fires back, it's all of it. But the bigger problem isn't that the government might shut down. The bigger problem is that it keeps operating the same way. That line lands because it feels true. Because the real risk to a currency isn't one dramatic event. The real risk is slow, persistent behavior. Deficits that don't shrink when times are good, promises that expand faster than production, and a political culture that treats hard choices like optional side quests. But here's where I'm going to push back, and I want you to tell me if you agree. Saying the dollar is going to collapse makes for great TV. It can also make for bad decisions. Currencies don't usually die in one day. They decay, they wobble, they get rescued. They get supported by policy shifts, and then the cycle repeats. And the dollar, for all its flaws, still sits at the center of global trade, global debt markets, and global banking. So I'm not here to sell you an apocalypse movie. I'm here to help you recognize incentives. And the incentive of a heavily indebted system is to reduce the real burden of debt over time. Sometimes that happens through growth, sometimes through spending cuts, and very often through inflation and currency weakness. That doesn't require a collapse. Oh, yes, it only requires a drift. And a drift is enough to make gold look smart. Now, the host usually tries to counter with something like, but hold on, we're getting decent numbers. Incomes are solid, productivity is rising. How can you call this a cold economy? And the guest says, those numbers are skewed. They'll be revised. Inflation is masking weakness. Gold is warning you the way it warned before the last crisis. Okay, here's my take. Yes, revisions happen. Yes, inflation can distort nominal data. And yes, markets often sniff trouble before headlines do. But we have to be careful with the everything is fake reflex because it can turn into its own blind spot. Sometimes the economy really is mixed. Sometimes corporations are fine while households are stretched. Sometimes the top slice of consumers is carrying the whole party while everyone else is counting pennies. So you can have a world where gold is right to rise even if not everything is collapsing. That nuance matters because it changes how you position and how you manage risk. Now let's zoom into the dollar because this is the part that most people feel but don't connect. A weaker dollar is a double-edged blade. If you sell globally and report in dollars, a weaker dollar can make overseas revenue look larger when it's converted back. That can lift stock indexes even when the real purchasing power is eroding. That's why you'll sometimes see the market cheer while the grocery bill still hurts. But if you import what you consume, and a lot of what we consume has foreign inputs, a weaker dollar also means higher costs. And higher costs can keep inflation sticky even when growth slows. So when someone says, you don't want too strong a dollar, they're not wrong. But when someone says a weak dollar is good, they're not always right either. The real question is, weak relative to what? And weak for who? Now, here's the twist that keeps people glued when they finally see it. Gold isn't only reacting to the dollar being down. Gold is reacting to the idea that policymakers might accept a weaker dollar as an outcome, not a problem. And that's why every tariff headline matters. Not because tariffs magically create wealth, but because tariffs can keep prices elevated while growth cools. And that combination is uncomfortable for any currency. According to the latest publicly available filings, many large institutions have been quietly increasing allocations to inflation-hedged assets over the past year. Not because they're panicking, but because they're hedging a regime change. a world where purchasing power is defended less aggressively than before. Now let's talk about central banks, because this is the part that people sensationalize. Central banks are buying gold. Sounds like a conspiracy headline. In reality, it's often boring and strategic. If you're running a national balance sheet, you want reserves that aren't someone else's liability. You want assets that can't be frozen with a keyboard. You want diversification. And gold has served that role for centuries, through empires, through wars, through monetary experiments, through policy mistakes. So yes, central bank buying matters. But no, it doesn't mean the dollar evaporates tomorrow. It means the world is slowly spreading its trust around. And that slow spread can still push gold higher for a long time. Because reserve managers move in big size, and they move in long cycles. Now, I can already hear someone typing, fine, so what's your target? Where does gold stop? If you want a clean number, I'm going to disappoint you. The ceiling on gold isn't a neat price level. It's a trust level. Gold stops accelerating when the currency story regains credibility. So instead of obsessing over a number, watch the conditions. Does government spending start showing restraint, not slogans? Does the central bank sound confident, not defensive? Do trade policies become predictable, not improvisational? Do real yields become meaningfully positive after inflation, not barely positive on paper? Because when those things happen, gold can cool off. But until then, it doesn't have to. Now I'm going to widen the lens, because this is where a lot of people get tricked. When you hear someone say, stocks are at records, so we're fine, that's a measurement problem. If the measuring stick is shrinking, your numbers can look huge. In the 70s, people learned this the hard way. Nominal prices rose, but purchasing power fell. In the early 2000s, we watched another cycle where hard assets outperformed while paper assets had a harder time when measured against real money. That's not a guarantee of the future. It's a reminder that your scoreboard matters. Now, here's the cliffhanger I promised. Even if you think gold is expensive, there's a corner of the market that can still be cheap. And it's the part that most people ignore because it feels complicated. Mining companies. Here's the paradox. You can have gold at record levels and still have investors shrug at miners. Why? Because miners come with baggage, operational risk, political risk, energy cost risk, management risk. People get burned once and then they swear off the whole sector. But when gold moves to a new regime, miners can re-rate fast because their earnings can expand faster than the price chart suggests. Let's do a simple mental math. If a miner's cost to pull an ounce out of the ground is roughly stable, and the selling price of that ounce rises, the margin expands. And margin expansion is rocket fuel for earnings. Earnings are what ultimately drive valuation, especially when investors stop treating the move as a temporary spike. Now here's what I personally watch with miners, because this is where you can separate storytelling from substance. I watch the cost curve. If a miner is constantly guiding higher costs, that's a warning. I watch jurisdiction. If the country has a history of rewriting royalty rules when prices rise, that's a warning. I watch balance sheets. If debt is heavy, a miner becomes a hostage to interest rates and refinancing windows. I watch energy exposure. If oil jumps, diesel and electricity costs can eat margins fast. And I watch dilution. If a company keeps issuing shares to survive, your upside gets watered down. Now, the TV-style argument you'll hear is, even though those stocks are up, they're cheaper because earnings are up even more. Well, that can be true. But the part I want to challenge is this. Not all miners benefit equally. Some miners hedge their output and cap their upside. Some are in areas where permitting delays can freeze growth for years. Some have management teams that love acquiring projects more than building profits. So the smart approach isn't buy anything with gold in the name. The smart approach is identify quality and then decide how much risk you can tolerate. And this is where the junior miners enter the chat. Big miners are like aircraft carriers. They move slowly. They're built to survive. They're owned by big funds. They're the default. Junior miners are speedboats. They can triple. They can also sink. When the sentiment changes, juniors can move like nothing else because a little bit of new capital can lift a small market cap quickly. But the landmines are real. A junior can have a great drill result and still fail if it can't finance the next phase. A junior can have a world-class deposit and still get crushed by political risk. A junior can be a winner, and you can still lose money if you buy at the wrong time with the wrong sizing. So if you want to play that area, it has to be with rules. Rule 1, don't bet the rent. Rule 2, diversify across a basket if you're not a specialist. Rule 3, expect volatility and don't confuse volatility with the thesis is broken. Now, here's my question for you. Do you want me to do a dedicated video on how to think about miners, including the basic red flags that can save you from disaster? Comment miners if you want that breakdown. And while you're commenting, remember this line. If you're successful, share your success story in the comments so others can stay motivated. Now, before we go further, I need to address the emotional core of this whole story because it's what people actually care about. People aren't buying gold because they want shiny metal. They're buying gold because they don't like the feeling that the rules keep changing. They don't like the feeling that every year costs more, even when they're doing everything right. They don't like the feeling that saving gets punished and borrowing gets rewarded. And when enough people feel that, you get a cultural shift toward hard assets, gold, silver, energy, land, and anything that feels less dependent on someone else's promise. But again, let's keep our brains on. Gold is not a magical shield. It can be volatile, it can pull back, it can chop sideways and bore you to tears. Anyone telling you it only goes up is selling you a bedtime story. So what should you actually watch next? Here's the checklist I'm using this week. First, the central bank statement language, not just the decision, the language. If you hear an emphasis on data dependence without clarity on which data matters most, that's uncertainty. If you hear repeated references to financial conditions, that's code for we're watching markets. If you hear an unusually strong defense of independence, that tells you pressure exists. And here's the small detail that most people skip. Listen for whether they talk more about inflation or more about growth. The balance tells you what they fear. Second, the funding drama. Even if a shutdown is avoided, pay attention to how it's avoided. Do they kick the can with a temporary patch? Do they split bills to isolate controversial agencies? Do they load the package with side deals? Because the method tells you whether governance is stable or improvisational. Third, tariff escalation. The market doesn't just price tariffs, it prices retaliation, supply chain rewiring, and the time it takes for companies to adapt. And companies can adapt. But adaptation costs money. It costs time. It raises prices before it lowers them. And money flows show up in currencies. Now, I promised you the part about the corner of the market that could surprise people if gold stays strong. Here it is. If gold is high and the dollar is soft, the next surprise can be the realization that record highs in stock indexes don't always mean record highs in real purchasing power. That's not a political statement. It's arithmetic. If the unit you measure in is shrinking, your scoreboard can look amazing while your purchasing power shrinks. So if you're only looking at nominal index levels and saying everything is fine, you might be missing the plot. And that plot twist is exactly why hard assets matter in a portfolio conversation. Now, let's talk about the most controversial claim you'll hear, that gold will replace the dollar. I'm skeptical of that as a literal near-term event. What I do think is happening is more subtle and more realistic. Diversification away from single-point dependence. Central banks can hold more gold without making gold the currency of daily transactions. Institutions can settle trade in multiple currencies without deleting the dollar overnight. Countries can build alternative systems without flipping a single switch. So the practical future looks less like a movie scene and more like a slow redistribution of trust. And in that world, gold doesn't need to become the currency. It only needs to become a bigger reserve. That's enough to matter. And let me connect this to something that sounds boring, but is actually the whole game: reserve currency privilege. When a currency sits at the center of global trade, the issuing country can run deficits longer than it should be able to. It can import more than it exports. It can borrow in its own currency. It can finance a massive military and a massive consumption economy without an immediate day of reckoning. But that privilege is not a law of physics. It's a deal. And every deal has terms. The unspoken terms are keep markets deep and liquid, keep rules relatively stable, keep institutions credible, and don't weaponize the system so aggressively that everyone starts building escape routes. Now think about what's been happening. More tariffs, more threats, more talk that sounds like we can do whatever we want because we're strong. Even when those comments are negotiation tactics, they have a cost. They nudge other countries and big institutions to diversify. And here's the scary part. You don't feel diversification at first. It shows up as little cracks, a few more trade deals settled in other currencies, a few more reserve managers trimming exposure, a few more buyers choosing hard assets instead of bonds. And then, one day, you look at the chart and you realize the little cracks became a trend. That's when people panic because they think the trend appeared overnight. It didn't. It was building quietly while everyone argued about the wrong headline. This is also why the shutdown story hits harder than people think. Because if the world is financing your system and they watch you flirt with a funding crisis every few months, it doesn't inspire confidence. It inspires contingency planning. And contingency planning is what gold represents. Now, I know some of you are saying, okay, but aren't there positives too? Absolutely. There are signs of resilience. There are companies still investing. There are workers still getting raises. There are pockets of productivity gains that are real. And that's why I'm pushing back on the extreme doom narrative. Because if you believe collapse is guaranteed, you'll make all or nothing bets. And all or nothing bets are usually how people get wrecked. My view is more practical. The risk isn't that the lights go out tomorrow. The risk is that purchasing power keeps leaking. and that the people with assets stay fine while the people who rely on wages fall behind. That's not a movie. That's a slow grind. Now here's a cliffhanger that most people don't consider. What if the central bank does exactly what everyone expects, and markets still freak out? That happens when the decision is priced, but the tone is not. The press conference is where the surprises live. One phrase about higher for longer, one hint about cutting sooner, one defensiveness about politics, one admission that inflation is sticky, and suddenly the market reprices the next 6 months in a heartbeat. So if you're only watching the rate decision headline, you're watching the appetizer. The main course is the explanation, and the dessert is the market reaction the morning after. Also, don't ignore the weirdest possibility of all, that gold stays strong even if the dollar bounces. That would signal something deeper than currency moves. It would signal a trust move. Now, let me give you a simple mental picture. Imagine the economy as a house. Tariffs are like turning up the thermostat and wondering why the bill rises. An uncertain policy is like the electrician saying, "I think the wiring is fine," while the lights flicker. Gold rallies when people start buying flashlights, because they don't like not knowing. One more thing, and this is where I'm going to get a little skeptical of the mainstream talking point. You'll hear people say tariffs are paid by other countries. In practice, tariffs get paid by whoever buys the goods after the cost is passed through the chain. Sometimes exporters absorb some of it, sometimes importers do, sometimes consumers do. But the idea that it's free money is fantasy. And when people realize it's not free money, they start thinking about inflation again. And when inflation becomes the underlying fear, gold becomes the underlying hedge. Based on recently published numbers, you can even see this in the way expectations swing. People don't need inflation to spike, they just need to believe it won't fully go away. That belief alone changes how capital moves. Now, you might be wondering why I'm spending so much time on narratives. Because markets are narrative machines. Prices move when the story changes. And right now, the story is shifting from inflation is temporary and under control to inflation is manageable but persistent. From deficits will normalize to deficits are structural. From trade is stable to trade is a lever. From the rulebook is clear to the rulebook is negotiable. That's a lot of story change in a short period. And when story change accelerates, gold tends to stay bid. But here's another cliffhanger. Sometimes the biggest move happens after the thing you're waiting for finally happens. Meaning, you might think, I'll wait for the rate decision, then I'll decide. And the market might move hardest after that, because uncertainty resolves and positioning unwinds. That's why I keep telling you, don't trade headlines, build a plan. Now, I want to keep the pace, so let me hit you with a rapid-fire set of truths. A government can avoid a shutdown and still lose credibility. A central bank can hold rates steady and still signal discomfort. A stock market can hit new highs and still be weaker in real terms. Gold can be expensive and still be early in a regime change. Miners can lag for months and then sprint in weeks. Okay, now let's address what you should do if you're feeling overwhelmed. First, stop trying to predict every tick. Second, decide what you're hedging against. Are you hedging inflation, currency weakness, geopolitical shock, policy chaos, or just the feeling that your savings aren't safe? Because the hedges differ. Third, size your position so you can sleep. If you're losing sleep, you're overexposed. Period. And that's why I like the idea of building layers. Some cash for flexibility, some broad equities for growth, some hard asset exposure for resilience, and then, if you choose, selective exposure to miners for torque. Not all in, not nothing. Layers. Now, let me pull you back to the headline. Gold at a record close. This is what that headline does psychologically. It forces every skeptic to make a decision. If they keep dismissing it, they risk missing a regime. If they chase it late, they risk buying a pullback, so they freeze. And when skeptics freeze, trend followers take control. That's how you get extension moves. Now I'm going to ask you a second engagement question, because I want to learn from you. What do you think is the real driver right now? The trade noise, the fiscal mess, or the central bank communication? Drop your answer in the comments and tell me why. And again, if you're successful, share your success story in the comments so others can stay motivated. Now, one more quick thing about the description, because I keep getting messages asking where to find the extras. The premium WhatsApp channel link and the channel membership join link are both in the description. No hunting. And speaking of membership, we offer members-only videos that are produced by a separate team with more research, and they're only for premium members. If you want the deeper dives, less headline, more evidence, consider joining. One more thing before we wrap, and this is important. If you're watching this and you're thinking, okay, John, but what if gold pulls back tomorrow? That's a fair question, and the honest answer is, it can. After big record closes, markets often do one of three things. They keep running because momentum traders pile in, they pause and churn because buyers and sellers fight over the new level, or they pull back hard because the move was crowded and people take profit. So the real edge isn't guessing which one happens. The real edge is having a plan for each scenario. If it runs, you don't chase with FOMO. If it churns, you don't get bored and abandon the thesis. If it pulls back, you don't panic sell at the worst moment. And that's why, even though this video is about gold and the dollar, the deeper lesson is about behavior. Because the markets punish emotions more than they punish ignorance, all right? Let's land this plane with a clean takeaway. Gold didn't hit a record close because one guy said one thing. It hit a record close because multiple stress lines are pulling at the same fabric. Trade policy uncertainty is adding friction. Fiscal brinkmanship is testing credibility. Monetary policy communication is shaping expectations. And underneath all of it is a quiet argument about trust. If trust stabilizes, gold can consolidate. If trust keeps leaking, gold can keep climbing. And the next big clue is going to come from the tone of policymakers and the behavior of the dollar after the next set of headlines hits. So here's what I want you to do. Watch the reaction, not the prediction. Watch whether dips get bought. Watch whether the dollar bounce attempts get sold. Watch whether miners start catching a bid, because when they do, it often signals that the market thinks the move is real. And if you want more of these breakdowns, the moment the next piece drops, make sure you're subscribed. I'm John AG, and I'll see you in the next video. This content is for education and discussion, not personal financial advice. I'm not telling you to buy or sell anything. I'm showing you how to think through risk, incentives, and narratives so you can make your own decisions with your own situation in mind.